Hello and welcome. I'm Vijay Srinivas, and we're discussing market mayhem as Trump tariffs wreak havoc on the global economy. No less a bloodbath on D Street yesterday as Sensex plummeted over 2,200 points. How can investors navigate these turbulent times? Joining me to discuss more is the founder of Equinomics Research, Mr. Chokkalingam. Thank you very much for your time. He joins us from Mumbai. Sir, let me begin with you there. We see widespread comparisons to yesterday's market correction to that of what has happened during the 2008 financial crisis. You've seen the highs and lows of financial markets there. What are your thoughts? And is it even too premature to talk about a potential recovery there?
No, it was misunderstood. The tariff war is going to stay here for long. There is no doubt about it. India is also going to be impacted. But the way the markets have reacted, once again falling more than 30 lakh crore in the last 7-8 trading days, is unwarranted, which is founded. I mean, this argument is based on a solid data points and logics. First of all, India is not an export-oriented economy in terms of goods exports. Goods exports account for only 10% of the total GDP. 90% of the GDP is driven by domestic demand and also IT services. And fortunately, IT services are not part of this tariff war or non-tariff war. So that is, in case that has been affected in the trade war, then India's story would have been very tough. Market would have seen more crisis. So point B, while overall exports 10% of GDP, our exports to USA is 20% of the total exports. So which means eventually only 2% of the GDP is vulnerable, India's exports. So that is not going to make a big difference because this 2% of GDP is not going to become zero. There could be 20%, 30% of this 2% impact could be there. Therefore, India's GDP can have 30 bips or 50 bips of fall, but market has overreacted. And secondly, as I mentioned, domestic demand is very strong. Along with that, in the last 20 years, whenever there was global crisis, India affected, but India was one of the major economies to gain also. How? Invariably, whether it was a Lehman crisis or 2016 deflationary condition or 2020 COVID pandemic, invariably what happened? Oil price crashed. As of yesterday, oil price crashed 30%, which is a big boon to Indian economy because we spend almost $140-150 billion of money on importing oil every year. So just imagine, even 20% saving would be about $30 billion. That will give big boost to your foreign exchange reserves, exchange rate, inflation rate, and eventually it will lead to interest rate cut. That happened invariably. So therefore, market has overreacted, and as long as service exports are not governed, India story would continue to rock. Most importantly, the China is the worst affected economy in terms of the tariff hike. All of us know. USA is also the worst affected because it has imposed a tariff hike on almost all major economies, almost on all major imports. So India is in between. So therefore, India is not likely to be affected very badly.
Okay, but no sector seems untouched yesterday. You see, every sector sort of, reeling under pressure in yesterday's trading. But if as the VIX spikes over 50%, I mean, which sectors, under your perspective, are the most vulnerable right now?
Basically, gems and jewelry, and that those exporters are not listed. And to some extent, auto sector would be affected, and market has already punished them. And these are the two sectors one can think of. But more than what would be impacted, one can always look at what would remain robust. That is domestic demand-driven sectors like telecom, nothing to do with the export market, banking industry, nothing to do with the export market. Growth would have slowed down, but still it is in double digits. So then domestic pharma. Domestic pharma, there are many domestic pharma-focused companies. They also got affected in this turmoil, but there was no reason at all. And domestic pharma market is remaining very strong. So then you have real estate-related stocks. So there are so many segments which are, not affected by the tariff or exchange rate. So one should focus on those segments and one should not basically panic and offload. As you rightly said yesterday, there was a panic and everything fell, and there was no rationale in punishing, even the financial stocks, domestic pharma companies. So market in the long term, medium to long term, the fundamental prevails. In the short term, speculation, fear factor, so many things impact, but market is very smart in the medium to long term. The punishment and rewards happen based on the fundamentals. This time also that would happen. A lot of quality stocks, I have a 100% conviction that they would start recovering from today itself.
Okay, so I mean, as we talk about quality stocks, and let's talk a little bit about the large caps as well. You see a lot of comfort zone in the large caps, particularly from a valuation point of view. There, even the mid and the small caps, for that matter, we're trading at a rich premium of about 40% versus historical averages. You see them, trading at close to 15% to historical averages. So a lot of froth has come up certainly there. Do you think this is the right time to sort of deploy capital at these levels?
Certainly, yes. But there is a one interesting insight in it. You are absolutely right. A large cap looks very cheap. It's around 21 PE, 21 PE. If you remove Zomato from Nifty and Sensex, just for argument's sake, I am not advocating that. The PE would come down, Sensex PE would come down even to 19. So the small cap PE still remains high. But there are two insights. One, in the Sensex and Nifty, you have 8 to 10 sectors dominating the broad indices. There, unfortunately, a majority of the sectors have what I call single-digit growth syndrome. Like FMCG volumes growth is single-digit, automobile volume growth is single-digit, IT services exports in dollar term is in single-digit, cement sales are in single-digit. So therefore, there are few more sectors which are having a single-digit growth. So therefore, yes, it is safe to invest in Sensex and Nifty. One should have 30 to 50% allocation to large caps from this perspective. But if you ask me from now whether the Sensex and Nifty will beat a small cap, mid cap, no. Because of this single digit growth syndrome. Now, coming back to small cap, the problem with the small cap is that it has got a universe of more than 4,000 stocks. So the average P is influenced by certain set of stocks. But otherwise, there are a vast majority of the small cap stocks which have fallen anywhere 30% to even 60% in the meltdown, and many of them are available at a single digit PE. Not only that, many of them do not have what I call the single digit growth syndrome, which we see in Sensex and Nifty sectors. There are many individual products and services, business models which still remain robust in small and mid cap. So there is a dichotomy within the small cap. Yes, of course, new age company, new energy company, many are trading at a very high valuation. But at the same time, there are many high quality stocks trading at a very attractive valuation. And according to me, that second set of small and mid cap stocks which are going to outperform the entire market in the short to medium term.
Okay, so I mean, despite the chaos yesterday, you see market experts advocating for buy on dips. What sectors should people be eyeing for now?
Yeah, certainly. As I mentioned, as of yesterday, nearly 105 lakh crore meltdown happened. If you adjust for the recent IPOs. Now, this is almost nearly 1/3 of India's nominal GDP for FY25. It's too huge. So this has created a lot of opportunities. So the first sector would be the public sector banks. Whole banking sector is attractive. Within that, public sector banks, many of them have become one-time price to adjusted book value. Then the second one is telecom sector, which will continue to grow. And, third would be the domestic pharma companies. You have to see that at least, more than 70% of the revenues from the domestic pharma. So there are many companies which have got even 80% of the total revenue coming from the domestic pharma. So these are the three sectors which are extremely appealing right now.
Okay, I mean, as we talk about pharma and IT, I want to ask you this question. JP Morgan warns of a 60% chance of global recession after Trump's tariffs there. India's IT sector and the pharma have significant exposure to the United States. And the popular opinion is to avoid these sectors. You see something else. You say something else there. There's a difference of opinion there. I mean, your thoughts on this, sir?
Time will prove. I think, I am a student of economics. Of course, I am not saying that what I say would become 100% true, but mine is based on solid logics.
Okay.
After Great Depression, a lot of tools are available for the central banks and the governments to avoid recession.
Mhm.
And a lot of learnings have been made. Now you look at last 20 years, this kind of talk came up after dot-com bust, after Lehman crisis,
That's right. Totally.
after 2016, January, February. Some people started writing a book also, Great Depression Revisited. Chances are very low for a great recession. Why? First of all, as I mentioned, tools and experiences are available. It's a very vast now. In Southern Europe debt crisis, overnight, European Bank created over 85 billion, euros through electronic mode and credited into the accounts of the banks overnight. Those things were not possible long ago. So now coming back to the US, see, US has to do this because otherwise US economy would be in a great crisis in the medium to long term. Trade deficit was more than 900 billion last year, and China generated $361 billion of trade surplus from USA alone in CY 2024. So at this rate of growth, the US economy would have been in crisis in the next 5 to 8 years. So the trade war is justified, and trade war is going to stay here. But if you ask me, whether this kind of aggressive trade war would be there for a long time, not at all possible for US. Look at the US markets, already down 18 to 22%. So more than $5 trillion wiped out. Look at small business in US; they are already suffering a lot. And US consumer used to buy goods cheap. So now US what has done? It has increased the duty very aggressive manner across all the products, across all the economies. So while China is going to be the worst affected, even US is going to be worst affected in the short term. So it is a part of trade tactics. This is not going to stay for long, this kind of aggressive tariff. If you see the smartness of Mr. Trump, even before implementing this aggressive tariff, he got certain deliveries through threat. India increased the import of oil from US by 50% in February. India increased the oil import from USA by 100% in March. So a lot of economies started adjusting and helping US economy even before these tariffs were announced. Now with the help of these aggressive tariffs, it is going to make a disequilibrium. It is going to upset the current equilibrium in favor of America marginally or quite significantly. And then Mr. Trump will go for compromise to solution. He will make a balanced approach, and thereby he would avoid a recession. No leadership can have disruption of wealth in the stock market and disruption of economy. Nobody can afford to do that. Now, the second important point, which is available for US recession, let us not forget the fact that interest rate 55 BPS. So there is a possibility, or there is a tool available for America, which is they can cut down the interest rate by 500 basis points to avoid the recession. So in America, this makes a big impact on, in the economic conditions. Let us not forget that tool available. So therefore, it is not going to lead to great recession at all.
Okay. And you think this is also the right time to invest in gold right now?
It is not ideal time to increase. One can hold. It is not ideal time to increase. See, the gold is a peculiar asset. It doesn't have any fundamental to decide demand and supply. It is more of perception driven, which leads to demand supply imbalances and creates a fall or rise. Now the point is, when equity asset class is in risk, the gold goes up. But when entire economy is going through little difficulty, gold as well as equity would fall. So now we are in the second situation where there is a lot of fear on the global economic growth itself. So there is no possibility of gold alone rising and equity falling. So if that is the situation, all will have a weakness.
One last question there, sir. We are having the MPC outcome tomorrow that's coming up. What are your expectations there? I think, the Trump tariffs could potentially hike, the inflation there in the United States, but it could be deflationary for India. You think it's high time for the Reserve Bank of India, the new RBI governor, to aggressively cut rates?
It is the right time to cut. But if not this time, in the next 2-3 months, the rate cut will happen in aggressive manner. As I mentioned earlier, global pain also has some gain for India, which is proven in the last 2 decades 3 times. Now, 4th time it is happening. Oil is down 30%, which is going to pull down the inflation rate substantially. And this morning, another very interesting development, as per the global media, the monsoon is going to be normal. So if monsoon is normal, and the oil price remains 25% to 30% cheaper, absolutely, one can expect RBI to cut down. It will be compelled to cut down to to manage these deflationary signs emerging across the world. Recession will not come, but prior to that, deflationary signs has already emerged in terms of metal prices and commodity, oil prices. So both are good for India to reduce inflation. Already inflation is well under control. You will see a significant fall in the inflation. Also, do not forget the fact that record level of crop output is expected this crop year ending June 2025. Along with that normal monsoon, cheap oil, we are set for a significant reversal of interest rate cycle that also will rescue Indian economy and markets.
Thank you very much, sir. Very insightful talking to you. Thank you.
Thank you.